Welcome to Academic Gain Tutorials. In this video, we will look into the differences between ADR and GDR. ADR stands for American Depository Receipts, which are a kind of negotiable security instrument that is issued by a U.S. bank representing a specific number of shares in a foreign company that trades in U.S. financial markets. ADRs make it easy for U.S. investors to purchase stock in foreign companies. On the other hand, GDR stands for Global Depository Receipts. It is a type of bank certificate that acts as shares in foreign companies. It is a mechanism by which a company can raise equity from the international market. GDR is issued by a depository bank located overseas, or in other words, GDR is issued by a depository bank which is located outside the domestic boundaries of the company to the residents of that country. GDR is mostly traded in the European market. Issuing GDR is one of the best ways to raise equity from overseas. So, let's look into the basic differences between ADR and GDR in a tabular form. Difference number 1. ADR stands for American Depository Receipts, whereas GDR stands for Global Depository Receipts. Number 2. ADRs are negotiable securities issued by a U.S. bank representing shares in a foreign company, traded in U.S. markets, whereas GDRs are negotiable securities issued by a foreign depository bank for trading shares of a company in international markets. Number 3. ADRs are traded in U.S. dollars, whereas GDRs are traded in both U.S. dollars and euros. Number 4. The purpose of ADRs is to facilitate U.S. investors in purchasing shares of foreign companies and allow foreign companies to access U.S. capital markets, whereas GDRs aim to facilitate raising equity from international markets by companies from different countries. Number 5. ADRs are primarily traded in United States financial markets, whereas GDRs are traded in international markets, primarily European markets. Number 6. ADRs are listed on U.S. stock exchanges like NASDAQ and NYSE, whereas GDRs are listed on non-U.S. stock exchanges such as the London Stock Exchange, LSE, and Euronext. Number 7. ADRs are issued by U.S. banks and financial institutions, whereas GDRs are issued by depository banks located outside the company's home country, often in Europe. Number 8. ADRs are regulated by the U.S. Securities and Exchange Commission, SEC, whereas GDRs are subject to regulations of the market where they are listed, such as the Financial Conduct Authority, FCA, in the UK or relevant European financial authorities. Number 9. ADRs primarily target U.S. investors, whereas GDRs target international investors, often from Europe. Number 10. ADRs generally have higher liquidity due to trading on major U.S. exchanges with higher trading volumes, whereas the liquidity of GDRs can vary depending on the international exchange they are listed on, often being lower due to a more diverse and dispersed investor base. Number 11. ADRs are subject to U.S. tax laws, with dividends potentially subject to U.S. withholding tax, whereas GDRs are subject to the tax laws of the country where they are issued, with dividend taxation varying according to the respective country's tax treaties and regulations. Number 12. Companies issuing ADRs must comply with U.S. GAAP or IFRS as accepted in the U.S. and adhere to the Sarbanes-Oxley Act and other SEC regulations, whereas companies issuing GDRs must comply with International Financial Reporting Standards, IFRS, or local GAAP of the listing country and meet the listing requirements of the foreign exchange. Number 13. ADRs are typically issued by large foreign companies with significant interest in accessing U.S. capital markets, whereas GDRs are often issued by companies seeking to access broader international capital markets, including those from emerging markets or smaller companies looking to attract foreign investment. Number 14. ADRs are less flexible in terms of currency and listing options as they are confined to U.S. markets and the U.S. dollar, whereas GDRs are more flexible with the option to trade in multiple currencies, USD, Euro, and on multiple international exchanges. Number 15. ADRs are seen as a way for U.S. investors to invest in foreign companies with ease, adding a level of credibility and familiarity due to U.S. market standards. whereas GDRs are viewed as a means for companies to expand their investor base globally, especially in European and other international markets, increasing global visibility and investment opportunities. And finally, difference number 16. For example, a Chinese company might issue ADRs to be traded on Nasdaq to attract US investors, whereas an Indian company might issue GDRs to be traded on the London Stock Exchange to attract European investors. So, these are the differences between ADR and GDR. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.